Prominent CEOs, top academics, leading economists, world-class athletes, iconic investors, civic leaders. Insights direct from the experts. The Walker Webcast with Willie Walker. Streaming Wednesdays. See who's next.
Welcome, everyone, and thank you, Walker & Dunlop, for sponsoring today's Leadership Huddle, and through this sponsorship, as well as the forums that you also host, for helping to advance thought leadership in the seniors housing and care industry. Today's NIC Leadership Huddle, Seniors Housing Equity Players Talk Investment Strategies, is the 8th Leadership Huddle of our 2021 webinar series. I'm Chuck Harry, NIC's Chief Operating Officer, and I have just one quick comment regarding the webinar's logistics ahead of our panel's discussion. If you need to adjust your audio for today's webinar, you have joined the webinar using either your computer speaker system or your phone based on your audio access during your most recent GoToWebinar session. You can adjust your audio access to today's webinar through either your computer speakers or your phone using the settings in the audio pane, which is located on the top of the control panel on the right side of your browser window. Moving to our panel discussion, it's my pleasure to introduce the host of today's Leadership Huddle, Jerry Taylor, Vice President of Operations at National Health Investors, Inc., which is also commonly known as NHI. Jerry works closely with NHI's asset management and business development teams on both current and future investments. Jerry has over 10 years of experience in the industry, the majority of which was spent in the day-to-day operations of senior living communities. Jerry also happens to be an alumni member of NIC's Future Leaders Council. Jerry, we look forward to the panel's perspectives of the investment opportunities in seniors housing.
Great. Good afternoon, everyone. Thank you, Chuck, and thank you to the NIC for the opportunity to participate today. We're very excited to visit with you and share some insights around investor outlook for the remainder of 2021 and thereafter. I'm joined today by Blake Peeper. Blake is the partner and co-chief investment officer for Bridge Seniors Housing Fund Manager, LLC. Blake has been involved in closing over $2 billion in real estate transactions over the past 10 years. I'm also joined by Dustin Warner, director in the transactions group for Harrison Street. Dustin leads the firm's seniors housing acquisition platform by directing the strategy, sourcing, and closing of all transactions. So gentlemen, thank you both for your participation today.
Thank you.
Thank you, Jerry. As we get started here, obviously a lot of different topics to cover, but really want to talk about kind of the recovery concept first. So the last 12 to 18 months has obviously been a roller coaster for not only our operators, but also our investors. So love to talk a little bit about your current portfolios and the operational performance that you've seen since January of 21. Dustin, I'll start with you. Can you share just a little bit about what you're seeing in your portfolio and maybe any specific product types or specific markets that stand out in the recovery concept?
Yeah, definitely happy to do so. So a little background on Harrison Street. Throughout our 15 years in the industry, we've invested in over 250 senior housing properties. Today, we stand at a portfolio of around 132 operating properties in 32 different states with 22 different operating partners. Looking back at COVID from March 2020 to today, it's been a journey to say the least. Like everyone in the industry, we've experienced occupancy pressures as well as other staffing and expense issues. But to kind of highlight, like you asked, Jerry, what's happened really starting this year, it's been very refreshing to see some very promising trends in our portfolio. With the onset of the vaccine rollout, we've seen COVID cases down to just a handful of residents in late first quarter of this year. We've also seen our leads, which we track pretty closely. They've increased significantly this quarter, and they're actually at the highest level since the onset of the pandemic. And lastly, I think we've been very pleased to see that total move-ins, they're nearly at pre-COVID first quarter 2020 levels. So a lot of really positive things that, as COVID has gone down and as the vaccine is rolled out, that we've seen in our portfolio, which is promising. I think, Jerry, you asked about market or product type differentiation or perspective. From a geography perspective, I'm not. There's nothing really intriguing to note. We are in 32 different states, but every region and partner has had to really manage COVID increases in their states and cities. It's impressive to see them keep residents and staff safe alongside of what's been kind of a complicated state by state, county by county, and city by city mandate regarding quarantines and testing. So I applaud all of our partners for doing that. But I think on the product type perspective, what's been interesting in our portfolio, at least, has been alongside our new construction deals. So we've, as a firm, we acquire and we develop alongside of our partners. And coming into COVID, we actually had 9 communities that opened in through August of 2020. And I think one thing we were very fortunate to see is that lease up at these properties actually trended pretty well, despite being in the middle of COVID. We had some properties reaching 5 to 8 move-ins per month. And I think another interesting item to know is that of those properties, independent living was a leader in terms of total move-ins per month.
That's great, super helpful. Blake, any thoughts, any additions you would make as far as your portfolio goes?
Yeah, thanks, Jerry. And just to provide a little bit of context on Bridge Seniors, geographically diverse with about 100 properties across 30 states, gives us a nice sample set to kind of understand and see the market in different ways. But I think the themes across our portfolio are very similar to Dustin's. We're really excited to see the recovery as of kind of beginning and middle of March. That gives us a lot of confidence as we go forward. But we get that confidence again through the rebounding of leads and tours, which are up in the 30% range relative to kind of the pre-vaccine period of time, and correspondingly our move-ins are up significantly, probably ahead of that actually from a percentage standpoint. So really nice to see. Other themes to maybe note, geographically, since the vaccine, we've seen certain locations recover a little bit quicker than others. Those areas that opened earlier than others, such as the Southeast, for example, we've seen patterns of a quicker recovery from an occupancy standpoint in those markets.
That's great. Great. So super helpful. I think kind of piggybacking off of that question, there's one of the biggest topics in the industry right now is the lack of really high quality operators and the opportunity there is. Certainly seen some winners and some losers through the pandemic. Blake, has your team identified any kind of outliers when you're thinking about quality operations that makes one group more successful than another?
Well, I'd start by saying that, we feel very good about our operating partners, the network of operators that we work with, and really applaud them for the diligent work that they've been able to do through the pandemic. It's really been an act of endurance, and just appreciate their partnership and all the things that they've done. And so going forward, we intend to expand the relationships that we have. We'll also establish new select manager relationships and grow through our own operating partner, Bridge Senior Living, in the markets that we know well. But as it relates to some observations through COVID, I'd start by saying maybe the corporate sales training and support has really been critical. The environment really shifted through COVID. Our customer has vastly different questions and concerns, and they're shopping for our product in a different way. They're really shopping online. So a lot of the first impressions and much of the discovery process is happening online before they pick up the phone and call us or or even come to visit us. So, that dovetails into scale of operator a little bit, and the theme of seeing some of the larger operators be able to react and respond a little bit better because of their ability to afford the corporate resources and infrastructure necessary to adapt and in many cases innovate in these really changing times. So seniors housing is still very much a local business, and we'll never discount the high touch, the importance of high touch, which you see in a lot of local operators. But those have been some interesting takeaways that we've observed.
That's great. Thanks, Blake. Justin, kind of building off of Blake's response there, how is Harrison Street looking at new potential operating partners and potentially adding new management teams to the stable when you're looking at a new investment?
Yeah, I would echo everything Blake said. I think infrastructure and support is ever more critical during this time period. But the lens by which we really look at operators isn't that much different than it was pre-COVID. I think it's an expanded lens. Obviously, there's a lot more questions regarding COVID protocols and everything regarding that. But at the end of the day, it really comes down to providing an enjoyable and safe environment for residents and employees, and for that operating partner to really have the infrastructure to support that kind of environment. So, what we've seen is in good times, it can be somewhat difficult to kind of glean that type of information from a group, but in hard times like COVID, it's much more visible and transparent into an organization. And we've been very, very pleased with all of our partners across the country and how they've handled this. And regarding looking at new investments and bringing in new partners, I think the past 12 months, it's been somewhat surprising to us that given the circumstances of COVID, we were actually able to form 3 new operator relationships through 2020. These weren't new groups that we started talking to in March of 2020. They were long-standing relationships that maybe had different capital sources, friends and family, or institutional, and we ended up being somewhat beneficiaries from some of that capital being sidelined. It actually is pretty similar to what happened during the GFC, where we formed some very long-standing partnerships back then. So yeah, big picture, we're laser focused on infrastructure. It's a very local business, so we enjoy working with our regional operators across the country. But it was kind of fun to form new relationships with groups that we knew, but didn't really have an in with them at that point.
Great. So lots of positive trends, lots of good stuff going on. Would either of you say that you're optimistic that kind of the worst of the pandemic is now in the rear view?
I can start. Knock on wood. Fearful to make any projections because with black swan events, you never know what's going to happen. But yeah, I would say I based on what we're seeing, there's a number of reasons to be optimistic. As mentioned in the first question, there's a number of trends that we're seeing in our own portfolio regarding leads, decreases in COVID cases, move-in strength, and then you look at the outside world with some of the publics that have their earnings. They've had very positive past few months. So from that perspective, it's great. I think the worst of the pandemic behind us as far as preparedness. Our partners and every operator across the country has been thrown through the ringer here. Prior to COVID, there wasn't really a handbook someone could take off the shelf. If there happened to be a second strain or something along those lines, we feel very confident and happy with the fact that there's somewhat of a playbook to go by at this point. And then just from overall supply and demand perspective, I think it's great to see a promising landscape. So new construction starts in the first quarter. We're at their lowest level since 2011. And then you look at kind of where the peak was in 2017, that's an 80% drop. So who knows if that'll continue for the foreseeable future. I think there's a bunch of limiting factors, including debt, that may keep that going for a little while, but you've got somewhat of a runway here to work with, and you combine that with what we perceive as a pent-up demand with a year of residents that want a place to live, and it's kind of a nice optimistic landscape for the future, in my opinion.
Great. Blake, any thoughts?
Yeah, I mean, that's well said, and not a whole lot to add. I think that we generally feel like Dustin, very optimistic that we're through the worst of it. Naturally, the leading indicators on the sales side speak to that. I think we've also just observed that the value proposition of seniors housing has really been validated in and through the pandemic. And we've, the sharp recovery that we saw in March, I think, is indicative of that. And we just think that long term, with the supply and demand fundamentals outlined by Dustin, that it's a pretty interesting time in the cycle, whereby we've had a real hit to occupancy, yet the medium and long term outlook from a fundamental perspective is really quite strong. So we're generally bullish.
That's great. Good color. Thank you. Would love to kind of transition a little bit to the disposition market and really talking about dispositions as an investor right now. So per the Senior Care Investor, 2020 transaction volume was down approximately $9 billion in total market value versus 2019. As funds who have maybe a shorter investment outlook, how has that change in market dynamics really impacted you, Blake, in looking at something that might have been up for disposition in the last 12 months or even in the next 12 months?
Yeah, it's changed a lot. We had targeted quite a few dispositions for 2020, which we pulled back on, at least from the majority of. Where we are in the life cycle of our funds is such that we're not forced sellers right now. Our lenders have been patient. We're seeing recovery in the portfolio. We're optimistic about that. So, for the time being, we're generally holding off on any, broad disposition strategies, and really want to sell from a position of strength when the time is right. With that being said, we think that there is a market to sell assets, and we've done that on a select basis, more on a one-off basis with certain assets that have performed well through COVID, or whereby we think that there's a strategic buyer for a particular asset. So we've tested the market some and have been pretty successful, but not on a broad basis.
Great. Dustin, how about Harrison Street? Would you say you're in a similar boat as Bridge?
Yeah, I think a lot of what Blake said, I would agree, and we went through ourselves. I'm sure, sitting down with his team in January, February, there was a plan to go to market on a handful of deals. We had the same thing happen, and that disposition pipeline shrank significantly by the end of March of 2020. We similarly, although we are a fund, we don't have any time issues. In addition to that, our investors they understand that we're long-term view players in the space, and so what really happened is we kind of shifted from a asset management perspective of disposition, and we took advantage of, prior to the capital markets completely freezing and rates at the time had dropped significantly. We actually were able to refinance a number of properties and either pull out cash or really reduce our rate just before it was weeks before the capital markets completely froze. So that was nice. And then from a resources standpoint, it takes a lot of time and energy to sell an asset, working with all of our partners. And so we really made it a point to kind of allocate a lot of those times and resources to be supportive of what our partners were going through in the trenches daily. And with 22 different partners across the country, we were seeing a ton of questions being asked and problems being solved by some partners, and others still weren't getting it. So we set up a lot of webinars and dedicated resources to that. So kind of shifted our gears from a mindset of here's a disposition year to, here's the allocation of resources to really help our partners through this with their properties.
Yeah, that's great. That's great. So obviously, none of us here have a crystal ball, and it's a really difficult question to ask. But when do you guys see the market kind of normalizing and getting back to the transaction volume that we saw in 2018 and 2019? And are there any key performance indicators or key metrics that you would watch to kind of lead you in that direction?
Well, I'll start by letting Blake answer this one incorrectly, and then I'll answer it incorrectly because I don't think we can either really guess what happened. Go ahead, Blake.
Yeah, so exactly right. It's anybody's guess. I think when we turn the page on the calendar, we're probably going to see more volume for a variety of reasons. Are there any metrics that are going to be catalytic towards causing that to happen? Again, who knows? I think occupancy is going to certainly play a significant role in that. When we get to a point whereby the gap between where we are today and stabilized value, if you will, shrinks some and shrinks to a point where those types of deals are financeable in a reasonable manner, I think then you really kind of open the market back up. So in some respects, it volleys back to what the occupancy recovery outlook's going to be, and I'm not gonna to take that bait at this point in time, but I sense that there's a lot of factors that are going to drive owners towards ultimately being sellers, even if they're selling, a little bit earlier than they want. So best guess is somewhere around the kind of flip of the calendar, just because it seems to be a natural break point there.
Perfect.
Yeah, I would echo all of that. It's impossible to tell. I'm not sure there's one or two or even three key performance indicators that will get us there. I think debt fully coming back to the market. Everyone's aware the debt markets froze and by April, and they come back, I think, about 50%. So when they're fully back and the markets open up, they're a good barometer of accessing capital for a lot of the funds out there that are sitting on a lot of cash. So fourth quarter, first quarter, we'll see.
Well put. Not committal, but well put. I like it. So we'll transition away from dispositions and kind of get to acquisitions, which I think has a lot of people interested. It's been stated by multiple brokerage firms as well as just kind of industry experts that there's somewhere between 9 billion and 12 billion in liquid capital that's been raised that's kind of waiting to be deployed in the senior space. So obviously a very liquid market and a lot of people looking for acquisitions. Dustin, I'll kind of start with you. I guess I would ask, how active has Harrison Street been in the acquisitions market since the start of the pandemic? And how does that compare to prior year?
Yeah, it was a pretty wild year. We had beginning first quarter of 2020, really steady pipeline, number of developments and acquisitions that we had closed prior to COVID becoming really headline news. By late March, that pipeline of 15 to 20 acquisition and development opportunities really went on the sideline for the most part. And there, like I said, it was asset management mode, working with our partners. But what was interesting was starting in early third quarter, we saw a number of really interesting opportunities come about with sellers that wanted to close by year end and or have very locked in capital that they knew through relationships that would get it done. So through that, we had, and with the debt market opening up, some of our developments that had been sidelined for some time also kind of got rejuvenated in terms of new spark and life to get them closed. So we ended the year with over 1.6 billion in new senior housing investments across development and in acquisitions. It's lower than previous years, but still, kind of a testament to our partners and our ability to kind of be patient through that, but not be completely pencils down. And the important thing to note here is these, as with most of the transactions that happened in 2020, they were between very strong relationship groups, having counterparties that you trust, that you can really get creative with. And when I say creative, there's a lot of items that pop up in normal transactions, and then you throw COVID in the mix, and you've got to be flexible and creative in structuring and timing and everything else. So to have groups that well, that you didn't just get to know through COVID was important. So that was 2020 for us. It was a very busy end of year. In 2021, it started out very strongly as well.
Thanks, Dustin. Blake, go ahead.
From our perspective, pretty similar in the sense that 2019 was one of our most robust acquisition years. So as we entered 2020, we were poised to have another big year on the buying front. That obviously didn't happen, and we kind of watched the pandemic play out to some extent. We do have an active fund, and we're actively pursuing deals. We have a lot of support from our investors investment committee, given our long-term view and commitment to the space. We did a transaction in December of 2020. It was a one-off relationship transaction that we just were really excited about. We had pursued it for quite some time, and felt like the long-term play was there, even in spite of some uncertainties in the market. Can talk more about that, but certainly in 2021, we're actively building a pipeline. We're working with our management partners and relationships on the sales side to target the types of deals that fit our strategy. And so we'll continue to do that. But overall, like I said, bullish on the space. I want to be an active buyer in this market, and are poised and ready to go with an active fund.
That's great. So just kind of building on that question, do either of you have any recent transactions you'd like to share, and just kind of give high-level details of what that transaction looked like for anything that happened in 21?
I can touch on it from a high level. One transaction we are very excited about that we closed. Like I mentioned before, a really relationship-driven partner, one that we'd been known for many years. It was kind of a mixed bag of new stabilized properties with new lease-up properties. This wasn't a distressed seller. It wasn't someone that was exiting the space. They wanted a long-term strategic partner to go and potentially chase opportunities together that are going to be distressed in the coming year, as well as a development partner. And fortunately, we have capital that can do both of those. So the initial conversations, the bid-ask spread was quite wide. But when you kind of drill down into where they were seeing the world and where we saw the world, like Blake said, we're also long-term investors. So we're looking at the long view in senior, and so we were able to creatively structure a number of things to kind of make it a win-win between both of us through creative debt structuring, short-term NOI guarantees, an earnout if they achieve certain hurdles. So at the end of the day, it was we went away very comfortable with the pricing, and they had a win-win. So but it wasn't without its challenges. It wasn't without its time, and getting debt in line in that time period was an exercise, but one that we look back on and are happy we got it done.
That's great. That's great. Thanks, Dustin.
Yeah.
So go ahead, Blake.
Yeah, I mean, I touched on it. The deal, that we did in December, it's in a prime submarket of a major MSA. It's, the market's vastly, underserved given the barriers to entry. The property had performed, very well prior to COVID. Operated by a local operator, as a kind of a local owner operator is how we sourced the deal. And we transitioned management to one of our top operating partners, and so that relationship and that confidence was very important to us. And we feel like it's a great example of buying a deal below replacement costs in a market that we have a lot of long-term confidence in. And I'd say it's pretty indicative of the types of deals that we would look to do going forward.
That's great. So I think Dustin kind of mentioned on it, but going back to the dry powder concept and the estimations that we've got about $10 billion in dry powder looming around the space, how has that impacted your kind of bid process on new deals? Are you finding there's a lot of other players at the table? What has that impact been for you? Blake, I'll start with you on that one if you're good.
Oh, sorry, Jerry, I wasn't.
You're good.
I would say that on deals that we have pursued, which has been pretty select at this point, it's been pretty, easy for us to filter the available deals into those that we'd like to pursue. The pool of buyers for those deals has been a little bit deeper than maybe I'd expected, and I might even say the same for pricing on some of those deals as well. So that the capital that is out there looking to deploy into seniors is certainly pervasive in the way that deals are unfolding, at least for the most part, and the ones that we've looked at, which should give us all some confidence that the capital market space broadly really does believe in this sector and is seeing all the positive signs that we're seeing.
Great.
But Blake, I'm sure you've heard this, but every broker I talk to says it's very lightly marketed and it's off market, and we have the inside track like you guys have, I'm sure too.
Oh yeah, of course we do.
We've seen the same. There's the market in the last 2-3 months has been picked up immensely. It's great to see the number of opportunities that have been out there. We're filtering a lot of them, and I think there's like you mentioned earlier, Jerry, there's $9 billion plus of dry powder out there that is that's looking to find a deal. I think in this climate, the opportunity needs to check a lot more boxes than normal, given where we're at with risk and everything else. But it is good to see a big uptick.
Good, that's great. So at NHI, we've had a lot of success in the last year as far as new business, really focusing on our operating partners and in them sourcing deals locally. That's where a lot of our success has been, on just kind of onesie-twosie deals sourced kind of by the operator. Dustin, what's the primary source of the deals that you guys are seeing and pursuing?
Yeah, it's very similar to what you just mentioned. We, like I mentioned, we've got 22 different operators across the country. They're very intimately involved in their sub-markets, and so we've had opportunities to acquire many portfolios of relationships that they've known for years. Likewise, we have relationships with a number of the large institutional players out there that are looking for very secure capital that'll get the job done. So we've had success through late last year with some of those public REITs. We're a little unique in terms of having multiple buckets of capital in seniors. So our value add fund, which is what we started the fund with in 2005, that can do development, repositionings, conversions, buy right opportunities. And alongside that, we have an open-ended core fund, which really plays nicely with our existing partners to either recapitalize properties that they own and want to manage and own long-term, or go chase, the marketed deals that are trading at premium cap rates. But having those different buckets of capital, it allows us to kind of see a lot of opportunities that may have not come across our desk. And development-wise, we're historically at 30 to 40% development, and so with those, the vast majority are completely off market through our partners, because the majority of our partners are vertically integrated groups that are chasing their sites and already have a relationship with us.
Great. Thanks, Dustin. Blake, can you give us any color? You mentioned a little bit earlier about, kind of your geographical footprint and where you want to be, but can you give us any color on the types of deals you guys are really interested in chasing right now, from market, geographic location, product type, et cetera?
Sure. I mean, I'd start by saying that, our investment approach from the standpoint of physical plant criteria and market criteria really hasn't changed since the pandemic. The market itself has changed, the dynamics have changed, and so we've shifted around a little bit to reflect, the current state of occupancy. But similar to Harrison Street, we have a diverse strategy in the sense that, the way we've built out our funds is to be able to invest across the spectrum, largely to allow us to grow and expand with our manager partner relationships that we value, but also to kind of pick our spots in different market cycles. And so we can do anything from kind of these stabilized deals all the way through to development. I think that we've used that strategy to our advantage in the past. And so as we look forward, we'll stay disciplined to find assets that fit our criteria. We've, generally speaking, gone up the quality scale on both products and markets. We've got a pretty refined view on what fits for us there. And then we'll really gauge selecting deals and based on how we underwrite from an NOI perspective, and really bridge that gap I referenced earlier from kind of the current state of occupancy and NOI to what it looks like going forward, and finding the right opportunities where we feel like that risk is compensated from a return perspective.
That's great. So Blake, I'm gonna hit you with the double question, because we know that Dustin's bullish on development. What's your appetite for development, and what would you say as far as like kind of a percentage of dollars out that might be?
We have some flexibility on that percentage, but call it give or take 25%. We're generally bullish on development and have spent a lot of time over the past several years establishing those relationships, those developer and operator relationships that are so important and valuable to that equation. So we've got a pretty deep pipeline right now of development. We're being cautious as it relates to both where the market is and where development costs are going. So we're studying that pretty hard right now. But when you evaluate the long term, we think that finding our way into the right types of new supply in the right markets makes some sense.
Great. Dustin, you want to give any development feedback, just since I already threw you under the bus?
Yeah, we've been developing since our first fund. We're very comfortable with it. I think it's we definitely align ourselves with the groups that have had experience and have the infrastructure for it. It's not an afterthought. It's been interesting to see over the past few years a number of very large institutional best-in-class developers that aren't operators enter the space. I think it's great for the industry, and we've aligned with a number of those groups in terms of forming co-GP partnerships between an operator and a developer. So that's been great. But yeah, like I said, 30 to 40% development with our partners. The vast majority are vertically integrated, so they're constantly working on different opportunities. But yeah.
That's great. That's great. I think there's been a lot of people with the thesis that there was going to be a lot of value add opportunities, given some of the distress that we saw during the pandemic and just the impact of COVID. Dustin, have you seen deals like that across your desk? And is that something that you guys might be chasing in some of your funds?
Definitely. We're very interested in those. You know, not every value add deal is distressed, but the ones that are, I think there's really two different types of distress that we've seen. You know, the first really has to do with true distress from a property or debt perspective. So here you're talking about a property that has run out of interest and operating reserves that was a development, or a property that, you know, is essentially self-funding. And here, you know, a lot of those opportunities that we've seen were likely on their way to being distressed prior to COVID. And so COVID was just really ignited and made those go much more quickly. And so those properties we're not all that interested in. You know, ones that have functional obsolescence, they were built in the wrong market with too much supply, or it was you know, really sponsored by a new entrant in the space that kind of structured the debt like a multifamily or other sector. So those ones, you know, we've seen a number of them, not like you said, not as many as we would have thought. And then there's the other distress that we've seen in the industry, which is not as distressed, but still groups that really want to exit. You know, they're likely newer entrants. They were very slowly leasing up pre-COVID. COVID set them back quite a bit. They're not, you know, self-funding or out of capital, but they just want to get out of their basis. And so when you look at those properties, when you look at kind of construction costs rising the way they are, and an ability to buy a new property in a market that that you generally like at below replacement costs or just at replacement costs, and a group that doesn't want to wait another 12 months to get back, those are interesting. We've seen a handful of those across the country.
Yeah, that's great. That's great. Well, guys, unfortunately, that went by super fast. I think we touched on a lot there. Really can't tell you how much I appreciate both of your participation. And to conclude, we'll hand it back over to Chuck.
Thank you, Jerry, and thank you for hosting today's panel discussion. And many thanks to both you, Blake, and Dustin, for your respective insights on the opportunities to invest in seniors housing. We welcome everyone to join us again in 2 weeks from today on Wednesday, May 26th at 2 p.m. Eastern and 11 a.m. Pacific for our next leadership, NIC Leadership Huddle. It's titled Trends Shaping Senior Living in a Post-Pandemic World. The upcoming webinar will feature a candid discussion with 3 senior living operators who will explore current trends and best practices to help fellow operators and their respective capital providers stay ahead of the curve, including how the pandemic has accelerated programs to effectively integrate healthcare components into senior living. We also hope that you can join us for the in-person 2021 NIC Fall Conference, taking place November 1st through 3rd at the Houston Marriott Marquis. Registration for the conference opens in early June, just a few weeks from today. You can sign up for email notifications by going to our website at nic.org/fall2021. On behalf of the National Investment Center for Seniors Housing and Care, thank you again to Walker & Dunlop for sponsoring today's leadership huddle. It's through sponsors such as Walker & Dunlop that, in large part, NIC can provide a forum for education and discussion such as this, and thereby help to enhance transparency, facilitate the efficient flow of capital in seniors housing and skilled nursing, and support access and choice for older adults. With that, we wish everyone a good afternoon. Thank you for having joined us. This concludes the webinar portion of today's Leadership Huddle.